Hey everyone, it is Monday, and that means we kick off our expert series, and we always kick it off with Mr. Greg Dickerson. How you doing today, sir?
I am doing great, Michael. How about you?
I'm doing very well. So one of the things I know I wanted to talk about today with you. So first off, I don't know if you've seen it, but Moderna kind of put out some interesting, very early phase 1 trials. It's kind of taken the stock market by storm. Did you catch that this morning?
Yeah, I saw that. I love the stock market, man. Stock market's up on hopes of new drug trial. And then the next day, stock market's down on concerns about new drug trial.
Yeah, I really appreciate real estate for its relative stability, no doubt. But yeah, I mean, you know, a little good news doesn't hurt. Also, obviously, probably a large percentage of the upside has been short sellers covering, but you know, the average Joe doesn't see that. But what I wanted to talk about today,
it's a few little key metrics here and there, and you know, just a few little players. So you know, it ain't over yet. You know, but hey, if we do get a treatment and vaccine and all that, then yeah, we can be off to the races. But you know, I don't know if you saw Chairman Powell on 60 Minutes yesterday.
I did, yeah.
Good interview. You know, he talked a lot of same stuff, but the common theme is maybe a little bit of growth towards the end of this year. Really need to get to the end of next year before you see any kind of real growth or recovery, assuming there's no big flare up again, second wave, third wave, and assuming we get vaccine and treatments and all that. So, you know, those are the big, caveats, the big factors that we got to look at.
Yeah. And let's be clear again, I've seen this movie before. The reason Powell went on 60 Minutes is because he's trying to get to the broader audience, right? Powell has been very focused on Bloomberg and CNBC and kind of the financial areas, kind of telling the same thing. Now he's trying to get to more people, right? Hence 60 Minutes and, you know, all of that stuff. So, but that's all good. Again, I think generally Monday morning, you know, people are starting to feel better. We're halfway through Q2.
Yeah.
I think we've seen the worst in a lot of numbers. You know, obviously the Q2 GDP is still going to be horrific. But the good news is everybody expects it at this point. So in order to get through hell, you got to keep going, right?
You know, the country's opening back up pretty much everywhere. People are getting back to work. You know, we just all we can do is wait and see. It's going to be, you know, the next 2 to 4 weeks are going to tell a lot in terms of what it looks like. If there's going to be another big flare up and how. The big question is, let's assume there is, you know, another second wave, because you would have to assume with everybody getting back out there, it's got to be, right? This thing just didn't go away. So we've got to have a rebound of this until we get treatment. So the question is, how does the country react now? I just don't see massive shutdowns unless it's just a major, major problem, you know. So the whole idea was for us to be able to work through this slowly, for the hospitals to be able to keep up. And I know there's people on both sides of this conversation. Some people think, hey, all this information's wrong. It's not as bad as everybody thinks. Some people say, hey, it's worse than what you think. What I'm saying is, you know, we just have to wait and see what happens, and then see what the response is if and when we do have a real situation.
Yeah. The one thing I want to talk about with you today is I'm always tracking the consumer, right? That's the thing I've been looking at for 20 years, because the consumer is my big competitor for residential real estate, right? They could come in for less down, they could pay more, they got better rates, you know, all that stuff. So they're my big competitor.
The retail buyer.
Yeah, the retail buyer. What I don't know, I guess I'll say forecasting, guessing, predicting, whatever words you want to use, is there are a couple of large states in the union, New York and California, that if, big capital letters, if, italics, bold, underline, whatever you want to say, if this work from home thing takes over, this large fiscal deficit kicks in with more taxes and fees and all of that, I am really suspecting we could see a mass exodus from New York and California. And I think that has two impacts that I want to talk about. One is, what do you think it does to New York and California? Because that's where people are leaving. But let's not forget, these people don't just evaporate in transition. They will land somewhere. In New York, I've already seen data from New York that Florida and Texas are getting hit. California appears to be Arizona, Nevada, and Texas. Right. So what does this mean for those, you know, states where we land, from both infrastructure and housing? I mean, it's just all of this stuff. So I guess the first thing to ask you, Greg, is do you see potential exodus from New York and California as something we should worry about, or at least think about, or is it just blown out of proportion and it just won't happen?
Yeah, that's an interesting conversation. California and New York have each had their own little, exodus going on to a degree because of taxes, because of rent controls, because of, business climate and things like that. And, you've got Elon Musk, fussing that he's going to leave California. He ain't going anywhere. It'll just cost way too much and take way too long. He can't just pick a factory up and drop it, in Texas. Unless he went to Detroit, you might be able to, find something vacant there. But it's interesting you asked that because, as you know, I coach people all over the country, and I was talking to a couple of people last week in New York City and from New York City, and these are millennials, and both of them young couples, no kids, and one of them, they're in Florida right now, both of them, getting out of the city in the interim, and one guy that lives in the city, he's like, man, he said in Manhattan, he said all you see are ambulances and moving trucks.
Wow.
He said it's really sad. There's nobody on the streets, people moving out. And, homeless people and ambulances running around. And he said, but for me, he said, I don't have a desire or a will to leave the city right now. So there's a number of people that are like, look, I love the city. I love New York. I'm not going anywhere. Then you have the other side where this other couple had a pretty interesting perspective. They said, we pay the premium to live in New York City for the entertainment, for the amenities, to be able to get out and enjoy things. And they said, New York's fundamentally been changed. You can't go to the theater. You can't go to the restaurants. You can't go to these parks. I did some stuff about that interview Sam Zell did. I think you did too the other day on Bloomberg. Yep. And he said, I got 5-star, Michelin 5-star takeout the other night, so New York has fundamentally been changed from a lifestyle standpoint that people pay a premium to experience. Just like San Francisco potentially, just like, LA potentially, and some of these other cities. So the question is, what kind of a factor is that, and how will that play into people's psyche? Now, this couple that said that didn't say, I'm definitely leaving. They said, we are definitely considering, based on how long things in New York stay shut down, and that element of quality and lifestyle changes. So that's what's interesting. So when you say exodus, what does that mean? We're already seeing people moving out into the suburbs with the home office because of the telecommuting and all that. So I think you're going to see that change. I think you're going to see a lot of people that were commuting into Manhattan that aren't now are like, why was I doing this before when I can work from home?
Yeah.
So you're going to see that shift in a lot of cities, where people like Twitter are just saying, look, if you want to work from home, and they're going to change their corporate structure and their office landscape. Just makes sense, right? Why pay for all that office when you found out now you don't need it? For people that don't want to have it. So that'll be interesting to see. And then for everybody listening, what you want to follow, this is called net migration patterns.
Yep.
So no matter what market you're studying, whether you're investing in commercial or residential real estate, you want to be where the demand is. So if you go Google net migration patterns, you'll find some free data sites where you can track this, and you can see where you have a net growth in population, and you can see the states that have the biggest migration, and you can see the states that have the biggest influx. And, we all know what the big three right now, right? Florida, Texas, Arizona. So, everybody's going to those states for a lot of different reasons, taxes, job growth, things like that. And then we know the big two, New York and California probably have the most people leaving. The other thing that was really interesting, I listened to an interview the other day, and I think it was Redfin and Zillow. So this is something else you can track, is their search data.
Yeah.
So they're seeing huge search data in like Idaho, coming from California, these other areas, people from New York and California searching these areas. So that's another data point to track is where people are searching.
Yeah, I agree with all that. I'm going to pivot a little bit from what we were going to go to next and talk about what I think this is. I think I don't want to call it a crash, every adjustment that at least I've invested through, there's always one main asset that's hit the most, right? The .com crash was obvious .coms, right? The Great Recession was residential real estate. I am now predicting, really based on what you were just outlining there, is this one is going to be about the great repricing of commercial real estate leases, right? You already see Starbucks going to all of their landlords and saying, hey, if you really want me, let's talk about a lower lease rate. And you have, I think the other one was I forget the other one. It escapes me at the moment, but I think that's going to happen, right? You talked about Twitter, right? Consolidating their footprint. I think that's going to be a thing. I think in New York, the financial institutions last week, three of the big five are saying, you know what, we're going to need half the space going forward. So I think lease rates are going to be repriced, which is also going to impact value. Do you think that trend has legs?
Yeah, absolutely. And we're already seeing it in a lot of areas. So here's, you asked what is the outcome of all this exodus and migration? The commercial markets are definitely going to fundamentally change. The cities themselves, the great quake of whatever it was in San Francisco did not take out San Francisco. Nothing will. New York, nothing is going to take out New York. New York is always going to be New York. What's going to fundamentally change, and what is already fundamentally changing, is the office and retail landscape.
Yep.
And even rent. So there's been a lot of articles out there lately about, how much vacancy there is in the residential markets in New York because the people aren't coming. Whether or not they leave is one question. How many are coming is a whole nother ballgame. And what's bringing them are these tech companies bringing people in. So if they start scaling back, that's going to scale back people moving to the area when they can telecommute. So yeah, we are already seeing all across the country, every retailer and every office user are renegotiating, and if they haven't, they're going to. So the real question is, what's that trickle back effect into the CMBS market that's financing these things? And we talked about that on another episode.
Yeah.
You've got the Fed propping that up. So I think there's going to be, a lot of this debt that's going to get worked out and worked through because, the government is not going to let these commercial assets just go on the block, but it is going to affect prices. It is going to affect values. And I think you're going to see rents come down all across the board, everywhere across the country. And, it used to be real estate was all about location. Well, if the foot traffic is down in those locations, which it is right now, then everything else comes down with it. And if you can't drive customers through the doors with a movie theater anymore that's not open, with a sports arena anymore that's not open, with hotels that aren't open because travelers and the conference business and all these other traffic drivers that you have that were driving these retail corridors around these, anchor tenants and events and things like that, that is going to fundamentally change all of that product all around there. Everything but the housing market, that right now isn't going to really be affected yet, because interest rates are below 3% right now.
Yeah.
It's just crazy.
Yeah, I think residential real estate is going to be fine, right? It's I keep saying it, right? It's water, food, shelter. Nobody wants to live in their car. It's a fact, right? So I think residential real estate, it will have some impacts, like again, New York and California, if this migration trend picks up and they raise taxes and they do things that they probably have to do, it will hurt prices here, right? Here meaning I'm in California and New York. But I think most of the country is going to be fine. It is going to be the commercial real estate that lease rates are changed, occupancy rates are changed. And again, I am playing in my head because again, I invested through the pain last time. How does this ultimately impact banks, right? I don't know if banks are as strong as they say they are. I don't know if they have reserved enough. And then the other point that you just brought up, is the Fed really going to be the backstop and just bail out? Because you got to reprice them. Commercial debt has terms, right? 3, 5, 7, 10 years, whatever it is. Most of these things, unless it remarkably changes, you can't refi the asset. You can't refi the asset and, you're in trouble.
Yeah, it's all going to get what's called mark to market. And that was the big issue that took out the residential housing market back in 2009, was this huge repricing of assets and marking it to market, because the banks were carrying the assets on their books at pre-2009 levels. And, so that's a big issue now with banking that makes a huge difference. But, Powell said it yesterday, the Fed's there, they're going to backstop everything. They're not going to let banks fail, because if that starts happening with what's going on right now, with 30% of the population unemployed at the moment, probably more, who knows what that outlook's going to look like, because as we creep back, all these jobs aren't going to instantly, get replaced. And the good news is if people got through to their unemployment, there's some good funding there, and they're talking about extending those benefits, which is great, because, people obviously need that, but it's going to keep some people from going back to work. And, the demand's not there anyways. It's going to take a while before you get everybody back out in force. And then even still, you're still missing that huge event segment that we were talking about of the economy, sporting events, weddings, banquets, conferences, all that. So there's still a big percentage of the economy that's not going to get back to work anytime soon. So like you said, the real question is, what's the effect at the level if we start marking to market? And I think what's going to happen is that's where the Fed's going to step in. So these banks are going to have to mark their assets down at some point, and then the Fed's going to come back in and buy those notes and restructure the debt, turn them into long term. So the Fed can't give money; they can loan money, right? Congress can give money; the Fed can loan it. So they're going to loan whatever they need to loan to shore up these assets and buy these loans and rework them. So that's what'll happen.
Yeah. I don't know if you know the answer to this. I probably should have looked it up before asking. So if you don't know, no problem. I'll look it up in a future video. Is the commercial CMBS market like 100, 10x, 20x the residential CMBS market? It's bigger, right? Just dollar wise, or no? Or do you know?
Yeah, I don't know exactly. You would think it is. Bless you.
Thank you.
And I can look that up while we're talking, but I would think the commercial and multifamily CMBS market would be bigger than residential. I'm gonna look it up right now.
Yeah, because again, I think this is interesting, again, with the lens of somebody who's invested through the residential crisis, which again was kind of 06 to 2010, whatever you want to call it. This could be a multi-year kind of slow unwind, because again, the real problem only becomes when you have to refi the debt, right? If you have a 7-year term and you just started it, you might be able to limp through. But then you get to the whole extend and pretend, and then you have, hey, were you in bridge financing or not? And you go, it's just, it can get really, really messy.
Yeah, I can't find it right real quick, so we'll have to look that up. But it's basically the MBS versus CMBS. So commercial mortgage-backed securities is one market.
Yep.
Which I think is 800 billion, something
I think
like that.
I think it's a trillion.
MBS, mortgage-backed securities.
Yeah,
is it $1 trillion?
I think it's $1 trillion is what I saw. And again, you got to be really careful, because I think it's obviously, I think more money, more total dollars, but it's also less assets. And that's what I got when I saw Freddie and Fannie talk about what multifamily, or what commercial, they didn't actually say multifamily, they said commercial, is already in forbearance, right? This was 2 weeks old. But basically they were saying there's already $1 billion in commercial assets in forbearance, but it was like 49 properties or something like that. I'm like, oh my God, what's the average price, right? So and it's almost $19 million. So it's
yeah, you would think it'd be bigger. And on the residential side, you have more houses that are owned outright, paid cash. So there's a lot of residential properties that don't have mortgages. There's some big numbers there in terms of default and forbearance on the residential market right now. Florida especially has got a really big percentage. So now here's an opportunity, one rental at a time, people. So you want to be buying and renting houses around these areas, around the cities where people want to move out and want to rent. So there is a trend now we're seeing in a lot of new development for rent communities.
Yeah.
So a lot of developers are switching their model. Instead of building and selling, they're building and renting. And a lot of the REITs are pumping money into that right now.
Yeah.
So for investors out there, if that's your game and you want to own single family houses, you want to own houses that are within close proximity of the city for people that still need to check in every once in a while to the offices. Now, in a lot of areas, those are not accessible, but maybe you're 20, 30 minutes outside, those areas. So now's the time to be on the forefront of that, because if there's going to be a movement, you're going to see a lot of that. People are going to look, 20, 30 minutes, around that city center and move out from there.
Yeah. I don't know if I've shared this with you. I've certainly shared it with my audience. I think the best single investment for the next decade is going to be a conservatively financed single family home bought below the median in whatever metro you're in. Ridiculously low rates, into an inflationary environment, into a trend of millennials wanting more space versus, Class A apartments, work from home. It's just, everything seems to be building behind the single family rental, in my opinion. And
it's a good wave. It's just not scalable, and it's, you know what I mean? It's just hard to scale it. You've been doing it forever, and it's just, you can't get 1,000 doors on the single family side.
The good news is, Greg, you don't need 1,000 doors. Most people are fine with 4.
It was big thinking, but yeah, you're right. So it can be whatever. It can be 4, it can be 100. You know,
Yeah.
most people I know that have scaled that have been in the 100 to 300
Sure.
range
Yeah,
in
me
single
too.
family homes. And yeah, it can be a great business model. It can be 2, 5, 10, whatever it is you need.
Yeah.
That's a great, thing. I did a video the other day because Sam Zell was talking about the
Yep.
safest investment right now, in
Yeah.
his opinion is multifamily. He went
Mm-hmm.
through all the types of properties and somebody replied and said, post office is the safest, single tenant, triple net guaranteed by the government, but that's not scalable. I mean, how many post offices can you really own? And post offices close too. So,
Yeah.
they're not always there forever. And there's consolidation in that business model, moving forward. So, there is no one size fits all best, possible thing, but people need roofs over their heads. That's multifamily, single family, mobile home parks.
Yeah.
That's number one. That's the safest form of a real estate investment you can make. It's the most sure, bet you can make. And you just can't go wrong. Even if it loses all of its value, you still have something you can trade in economic Armageddon. So economy shuts down, dollar becomes worthless, our monetary system is gone. If you own housing, you can trade it for chickens, you can trade it for cows, you can trade it for services. When you go back to the days of the agrarian society, the wealthiest people were the landowners, and they had tenant farmers, and they gave housing for services.
Yeah.
So
yeah,
hopefully we won't see that, but
yeah,
if we do and you own houses, you're safe.
Yeah, I think most folks, right? Most folks on my channel have full-time jobs, right? They don't have the luxury of being full-time investors. So I keep telling them, right? If you can get to 4 rental homes in this cycle, your financial future has changed. And if you want to be a big thinker, go for 10. I think that changes people's lives. You don't have to grow to 200 or 300.
Yeah, you don't need a ton. It just depends on what you're trying to do. If you're trying to replace, $100, $200, $300,000 a year salary, okay. Now think of it this way, and I don't know how much you've talked about this, but you might want to focus some attention on this.
Okay.
Is bonus depreciation.
Mm-hmm.
Okay, so if you're making $300,000 a year, you're in the highest tax bracket. Okay, and if you're investing in real estate, man, you can take advantage of depreciation and bonus depreciation, accelerated depreciation, and cost segregation to offset your W-2 income. Now, the really cool thing is if you can transition yourself to where you become a full-time real estate professional, then there are even more tax benefits where you can offset gains, do all that kind of stuff. So, there's some huge, huge tax advantages for the W-2 employee to invest in smaller assets that they own themselves versus like syndications and things like that, where you get a little bit of the depreciation. But if you go buy a smaller, asset that you can own on your own, 1 house, 2 units, 10 units, 30 units, whatever, there's some huge, huge tax advantages to that if you're a W-2 person that will, help you escalate your path to that.
Yeah. And again, folks, talk with your CPAs and attorneys and make sure neither one of us are that. We're just giving you our experience. So I always want to have that caveat there. Talk to your accountant. But yeah, you're absolutely right. I saw the largest adjustment in my taxes when I was able to legally claim being a real estate professional, right? When I could document the hours and all of that. It's an amazing thing what is out there when you have that depreciation, bonus depreciation, cost segregation. It is a legal way to hide income. I mean, hide's the wrong word. I don't know what you would call it. Yeah, hide.
So you're just reducing your taxes. So you got to understand the tax code exists to help you reduce your taxes. So what a lot of people don't understand, the government wants you to reduce your taxes. Because here's why that works. When you buy property, you're stimulating the economy. You're creating jobs, you're investing, and you're stimulating the economy. That's why you get those tax incentives. So they're loopholes, but they're not, it's not skirting, it's not hiding, it's not evading. It's taking advantage of the tax code that was created for investors to be able to invest and create opportunity and spur the economy, just like retirement. The government doesn't want to take care of you. They want you to build your own retirement. That's why they give you tax sheltered retirement vehicles. That's why they give you tax sheltered, investment vehicles, all that. So it's incentive for you to reduce your tax. That's why that tax code exists. If they didn't, it would be 3 pages, and they would just take your money.
Very cool. Thank you for that. That was very well said. Yes. Incentive to lower your taxes. I love that. So as we kind of wrap up this weekly show, what is, what is this? Where does opportunity sort of in your, are you on the afraid to aggressive? Where are you in your personal view of this? Because it changes all the time with the headlines. Are you, if 0 is I'm afraid and doing nothing, and 10 is like I'm taking every dollar I have and buying stuff today, where are you on that 0 to 10?
So I'm never afraid. So I'm opportunistic. So I'm always looking for opportunities for distress situations. Okay, and that comes in a lot of forms.
Yep.
So what I am is I'm patient. So I'm not afraid. I'm not. I don't feel like I'm going to miss out. I don't have to do anything. What I am is I am patient. So number one, I understand how to recognize value, and I know how to spot opportunity, and then I'm in a position to take advantage when I see it. Yeah. So that's kind of how I am. I'm kind of like the tiger kind of, stalking his prey, waiting. And and then when that sucker pops his head up from the bush, I'm on him. Right. So
yeah. I love that. Yeah. I think that's actually I'm glad you said it that way. We are both in a situation where we are both being patient, right? We're looking for the opportunity, the value add. I'll strike, like I did a deal. I locked up a deal last Monday that worked in any environment. And I'll continue to do that. So yeah, I think patience is the right key. Don't rush. Don't catch a falling knife. I have too many people who have money burning a hole in their pocket, right? They liquidated their stock portfolio. They're sitting on all this cash and like, I gotta buy, I gotta buy, I gotta buy. Oh my God.
I've got people like that in my ear, and I just tell them, look, you got to be patient. There's too much uncertainty right now. You want to be able to recognize opportunity when you see it and understand value when it presents itself. So I'm 52, hundreds of millions of dollars of deals under my belt, real estate and businesses. When I was in my late 20s, early 30s getting started, I felt like, man, this is the opportunity of a lifetime. I got it, The opportunity of a lifetime comes along every single day. You just got to know how to spot it. The opportunity of a lifetime comes along every single day. You just got to know how to spot it.
I think that is a great way to wrap it up. The opportunity of a lifetime comes around each and every day. Greg, I want to thank you very much for giving us your time this Monday morning.
Yeah, man. It was good to talk with you, Michael.
You got it.